Welcome, dear learners. Today, we will be exploring Unit 36, which focuses on the significant role of microfinance in rural India. We will delve into its fundamental concepts, the reasons of its necessity, particularly in the Indian rural context, and its operational structure. Before we proceed, let's outline our learning objectives for this session. By the end of this lecture, you should be able to first understand the basic concepts related to microfinance and its contribution to the Indian economy. Second, recognize the role microfinance plays in generating employment. Third, learn about how government programs have influenced microfinance development. And finally, understand the impact of microfinance on women's self help groups and overall poverty eradication in India. Let's begin with the introduction. What exactly is microfinance? It refers to the provision of various financial services specifically tailored for low income groups. This includes individuals and self employed people. The core idea is to provide sustainable access to funds that these groups can use to generate more income. Microfinance isn't just about loans, it encompasses services like savings, insurance, and fund transfers. It has been a major factor in expanding financial services in rural areas, primarily by offering low cost financing, often without complex documentation requirements. In India, NABARD, that is, the National Bank for Agriculture and Rural Development, plays a crucial role by providing financial assistance to numerous banks. These banks, in turn, channel funds to self help groups, often called SHGs. Many SHGs consist of women or tribal members. The process typically involves members saving small amounts regularly. Based on these savings, they can borrow from the group. Once they gain experience in managing finances, they become eligible to borrow larger sums from banks, often investing in small business activities. The lending system can leverage the group's savings significantly, sometimes lending up to four times the amount saved. Repayment usually occurs within a year, with interest rates typically ranging from 12 to 20%. It's important to distinguish microfinance from microcredit. While microcredit specifically focuses on providing small loans for establishing micro businesses to fight poverty, microfinance has a broader scope. It includes other financial services and strongly emphasizes women's empowerment, aiming to improve their social status. Many microfinance initiatives actively partner with non-profit organizations and women's self-help groups. Moving on to the basic concept of microfinance. Essentially, microfinance provides credit and other financial services like money, transfers, and microinsurance to economically marginalized individuals. The core intention is always to improve the income level and living standard of this targeted population. Robinson defines it as small scale financial services, including both deposits and credits, offered to those in farming or micro enterprises in both rural and urban settings. The concept covers a wide array of services: savings, credit, insurance, money transfers, and even financial support for housing or skill development through business ventures. The ultimate goal remains poverty elevation and enhancing quality of life. It acts as a vital credit support system for those unable to generate sufficient income with their existing resources. The guiding principles revolve around fostering self employment, improving income and living standards, and reducing poverty levels. Historically, the idea gained ground in India through steps like the Cooperative Societies Act of 1903, early microcredit programs by Syndicate Bank in the 1920s, and significantly after the nationalization of banks in 1969. Government programs like the Integrated Rural Development Program also emphasized investment loans. However, the modern microfinance movement, emphasizing repayment discipline, gained significant momentum with NABARD's self help group program launched in 1992. This modern approach introduced concepts like linking loans to savings and repayment capacity, and importantly, peer group monitoring. This peer pressure within the self help groups helps reduce lending risk. While immediate income growth isn't guaranteed, microfinance helps stabilize household finances, manage expenditures, and cushion the impact of shocks like unemployment, illness, crop failure, or natural disasters, thus contributing to poverty reduction. So, why is there such a strong need for microfinance, specifically in rural India? The rural economy is constantly changing, especially with the commercialization of agriculture. This shift towards cash crops increases the need for finance to buy inputs like seeds, fertilizers, and pesticides. Traditionally, moneylenders or commission agents have been major players in rural credit. They offer funds quickly with minimal procedures, but often at exorbitant interest rates. Rural people need credit not just for agricultural production but also for consumption, social or religious events, education, and medical emergencies. Needs that the formal banking system often couldn't or wouldn't cater to. This gap created a demand for a parallel credit system capable of meeting the diverse requirements of rural households. Research, including findings by the World Bank, showed a significant need for consumption credit, often sourced from informal lenders at very high rates, sometimes which could be 30 to 90%. Even initiatives like Kisan Credit Card were often limited in meeting these consumption needs. Furthermore, past experiences with subsidized credit sometimes lead to repayment problems and rising non performing assets that we call NPA for banks. Therefore, the critical challenge for the rural poor was, and often still is, gaining access to credit while also ensuring timely repayment. Microfinance institutions emerged to address this, demonstrating that it is possible to lend to the poor sustainably, often by linking services to saving and emphasizing repayment discipline inspired by models like the Grameen Bank. However, the expansion and effectiveness of microfinance are not without challenges and limitations. The growth in some areas has been slow due to shortcomings in the delivery mechanism. What are some of these issues? Firstly, tenancy acts can sometimes make it difficult for banks to lend for working capital if land ownership is unclear. Secondly, the slow pace of formal banking expansion in some rural areas limits the overall credit availability, reflected in a low credit deposit ratio. Thirdly, many primary agriculture credit societies that we call PACS, which are grassroots cooperative structures, are financially weak or lack sufficient funds, limiting their ability to lend adequately to their members. Fourthly, following financial sector reforms, commercial banks understandably increased their focus on profitability, which sometimes lead to a reduced emphasis on lending to priority sectors or rural populations compared to more lucrative investments. Fifth, regional rural banks, which we call RRBs, and some cooperative banks have also faced constraints, including issues with high operational costs and sometimes high non performing assets due to challenges in loan recovery. Finally, the cost of financial intermediation in rural areas can be high, making loans more expensive, and the formal banking system can sometimes struggle to adapt quickly to the diverse and dynamic credit needs of the rural population. Finally, let's examine the structure of microfinance in India. India employs a composite system, meaning it cleverly integrates international models like the Grameen Bank approach from Bangladesh with its strong indigenous self help groups model. This blend aims to improve distribution channels and maximize impact. Microfinance is widely recognized as an effective instrument for poverty reduction, particularly in developing countries like India. Several types of institutions form this structure. Non governmental organizations, that we call NGOs, often play a vital role, especially in forming and nurturing self help groups. Then we have the cooperative banking system, which includes rural cooperatives focused on agriculture and urban cooperative banks. A prominent example is the Seva Bank, dedicated to helping poor urban women. Commercial banks are major players mandated by the Reserve Bank of India to lend a portion of their funds to the priority sector, which includes agriculture, small scale industries, and loans to microfinance institutions or self help groups. Regional rural banks are specifically designed to serve the needs of agriculture and rural micro enterprises. A significant portion of credit, especially through cooperatives, targets agriculture and related activities. Priority sector lending specifically aims to reach disadvantaged groups like scheduled castes, scheduled tribes, and small or marginal farmers. Banks, whether lending directly or through specialized microfinance agencies, acts as crucial conducts attempting to narrow the persistent gap between the demand for and supply of rural credit. This structure has led to an increase in the number of microfinance institutions and contributes to enhancing rural incomes. Continuing our discussion on the structure, let's now look at the different forms of microfinance institutes or MFIs. Operating in India, a wider array of institutions provide microfinance services to meet the needs of the underprivileged population. These include formal players like commercial banks, cooperative banks, and regional rural banks, as well as self help groups, non government organizations, and increasingly dedicated non banking financial companies specializing in microfinance. We can broadly categorize these diverse institutions into three main types based on their operational principles. First, we have non-profit microfinance institutes. These organizations operate on a not for profit basis. Their primary goal is service delivery and they typically lend funds covering only their operational costs. Legally, these can be registered as societies under the Societies Registration Act of 1860, as public trust under the Indian Trust Act of 1882, or as non-profit companies under what was formerly Section 25, now Section 8 of the Companies Act. Second, there are mutual benefit microfinance institutions. As the name suggests, these are set up for the mutual benefit of their members and beneficiaries. This category includes various cooperative structures like national or state level credit cooperatives and mutually aided cooperative societies, which provide credit based on their members' requirement. Third, we find profit motivated microfinance institutions. These entities operate with the intention of generating a surplus over their cost. The most prominent example are non-banking financial companies that we call NBFCs registered under the Companies Act, which have become significant players in the microfinance sector. The provided text also mentions that banks, often operating commercially, and key developmental financial institutions like NABARD and SIDBI, which play crucial role in refinancing and supporting the rural credit sector, are sometimes viewed within this broader context of commercially oriented operations or support systems for lending in rural areas. Now, let's look more closely at the different organizational participants involved in the successful growth of microfinance in India. Starting with non governmental organizations or NGOs. Historically, NGOs were primarily associated with social services like health, education, and environmental awareness. However, their focus has increasingly shifted to include financial domains, particularly working to empower economically disadvantaged and marginalized populations through financial awareness and inclusion. There are over 500 NGOs actively providing financial services in the form of microfinance. Key institutions like NABARD, SIDBI, and the Rashtriya Mahila Kosh recognize NGOs as vital players in connecting people at grassroots level with financial stability. NGOs are responsive and play a strategic role in promoting microfinance. Importantly, regulations typically prevent NGOs from engaging directly in commercial activities. Therefore, they usually don't have their own large capital base for lending. Instead, they act as crucial financial intermediaries. They leverage funds from established financial institutions and channel them to smaller groups, often in the self employed sector. Many NGOs have become highly effective in nursing, organizing, and stabilizing self help groups, thereby linking the formal banking system with the previously unbanked poor. A Reserve Bank of India working group formed in 1995 specifically highlighted that NGOs contribute not just by channelizing funds but also significantly through education and empowerment of the rural population. They often act as a catalyst, guide, and friend in the overall development and expansion of self help groups. Continuing with organizational participants, next we have federations of self help groups. These are formal institutions typically registered under the Societies Registration Act or similar state laws. NGOs often take the initiative to form these federations by bringing together village level self help groups into cluster. This allows groups to pool their resources, creating a large collective fund. The federation often takes a responsibility like providing training, auditing services, and generally supporting the self help groups towards self reliance. Examples include well known organizations like Mairada and Seva, which have facilitated such federations. These federations also receive support from banks, both financial and non financial, like training or marketing assistance. Another form is cooperative societies, particularly those established under Act like the Andhra Pradesh Mutually Aided Cooperative Societies that we call MACS Act in 1995. These are envisioned as voluntary, self sufficient business enterprises focused on the social and economic development of their members. They enjoy managerial freedom to manage their affairs and raise resources, but are distinct in that they typically cannot receive financial support or equity from the government. Finally, we have financial companies, specifically non banking financial companies that we call NBFCs, involved in microfinance. These are registered under the Companies Act and are regulated by the Reserve Bank of India, especially following amendments to the RBI Act in 1997. NBFC and MFIs are generally profit motivated. They are subjected to a specific regulatory framework which includes mandatory registration with the Reserve Bank of India, maintaining minimum net owned fund, adhering to prudential norms like capital adequacy and liquidity requirements. For example, 12% capital adequacy and 15% liquid assets on public deposits are mentioned in the text. Rules regarding public deposit acceptance, often linked to their credit rating, along with prescribed interest rate ceilings. Dear learners, here we pause our first part of this video lecture, where we have discussed about the meaning and basic concept of microfinance. We have also discussed about the need of microfinance in rural India along with challenges, structure and different organizational participants in microfinancial sector in India. In the second part of this video lecture, we will be discussing about the role of NABARD, SIDBI and Rashtriya Mahila Kosh. We shall also discuss about functions, importance and limitations of microfinance in rural marketing in India. Until then, stay connected and keep learning.